Hey team, Ben Nash from Pivot Wealth here, and today I'm coming to you to chat about investment market updates for the month of September. It's been a big one in the investment and property markets with a bunch of stuff going on. We're seeing a bit of disruption in share markets, both in Australia and in America in particular. COVID vaccination targets getting achieved, uh, Australian borders opening up, Australian cities opening up. Fortunate to be in Sydney. Very excited for next Monday when I can actually sit down and have a coffee somewhere at a cafe. That's pretty exciting. And yeah, the property market also is pretty hot. So I'm going to download some of the things that I've been seeing, things to look out for, as well as some of the mistakes and issues we've seen over the last month. So look, in terms of the property market kicking off there, we've been seeing a lot of activity in the property market. We're still seeing really constrained supply in Australian capital cities in particular. Very limited supply and a lot of demand, which is keeping property prices high. Now, property prices, there's growth rates are still increasing, but they're starting to slow down a little bit. One of the things that was really interesting that happened in the last month was that the IMF, or International Monetary Fund, have come out and talked about the overheated Australian property market and noted that that's posing a little bit of risk to the Australian economy, potentially moving forward from here. And their suggestion was that APRA, or the Australian Prudential Regulatory Authority, that they crack down on the banks or impose some conditions on the banks to have them to wind back some of their borrowing and lending standards. And if they do that, what they'll effectively be doing is making it harder for people to borrow money. And when they make it harder for people to borrow money, they're sort of winding back on the demand side of the equation there as well. So really interesting. Whether it comes to pass or not, I suppose it remains to be seen. However, I think for anyone that's looking at getting into the property market now, I think before things change, it's probably worth getting your ducks lined up. And if this is the right move for you, that pushing forward to do that, because I know that the last time APRA got involved in markets was off the back of some of the things that came out of the Royal Commission into banking. And it got really strict with their lending criteria. And we were seeing a lot of people that had seemingly like really high income, strong cash flow. We're doing these detailed financial models that shows they could really comfortably afford to buy properties, but they were getting knocked back by the banks because their standards, how they were assessing them, which were mandated by APRA, were quite extreme, and that did stop a whole bunch of people from being able to do the things that they wanted. So something to keep in mind if you're going down that path. Speak to your people and make sure that you've got things lined up so that they come together the way that you want them to. In terms of share markets, both in Australia and around the world, we've seen ASX is down 2% through September, but it's now down actually 5% from the peak in August. And I've been getting a few questions from people, from clients around that. Just concerned about seeing dips in their investment account value, super funds, etc., which totally makes sense. Look, we're also seeing in America, the S&P 500 is down 0.63%, but 3.7% from the peak. The NASDAQ is down 1% over September, 1.1%, which is 5.6% down from the peak in early September. The FTSE, the FTSE which is a global index, is down only 1.2% from its peak. And interestingly, like you see that the S&P 500, which is like an industrial index across the 500 largest companies, a lot of industrials in America, less impacted than the NASDAQ. The tech stocks have been whacked pretty hard. And talking to a lot of tech people that have seen their options plans, restricted stock, just getting a real battering. And I'm actually going to elaborate in a little bit more detail about some of the stuff that we're seeing there today as well. But the markets have clearly copped a bit of a hit. On the flip side, the crypto market, and I think there's probably a relationship there, but I I believe there is. The crypto market is up 30% for the month. That we're seeing Bitcoin is up pretty significantly, a big driver of that. So the crypto supporters have done well at a time the market's done less well, and I believe that that's probably something that will continue, because as markets going down, people are uncertain, especially younger investors, bit cashed up. They're looking at alternatives. Crypto is there. It's seen some good growth, and I think that will continue. So an interesting space to watch over the next little bit. One of the big drivers of what we're seeing in markets is the US bond rates have been increasing on government debt. So that's when the government issues these bonds. We saw for the first time in a very long time the government in the US increasing the interest rate that they're paying on the bonds. And why that impacts markets is because for investors that are looking, and especially big investors that are looking to deploy cash, when the bond rates are close to basically zero, they know that putting the money into bonds is going to give them zero, right? Makes sense. So then they're more comfortable to invest into share markets, even if they think the returns are going to be pretty flat, because they think that over time they're going to get that upside in growth. But when the interest rates go up, then they second guess their choices and start putting a little bit more into that bond market, which means that they're either selling down from share markets or putting less in, less demand, less growth, and that's copying the downside. Now, the other thing that's dragging down markets is that the US debt ceiling, they're working to get that. They're about to max out their credit card. The USA's credit card is getting close to max, so they need to negotiate that, and there's some politicking happening over there. Also putting some worries into markets. And look, one of the positives for markets is we're seeing these COVID treatment drugs being approved. There was some really good study showing that the impact with this new COVID treatment drug that's come out seriously reduces hospitalization and death significantly. It's around a 50% reduction in some of those pretty terrible stats from people getting impacted by COVID. And so as a result of that, where you think forward to the future, that we should be seeing people, economies opening up more, because there's more ability for people to protect themselves, even if they do get COVID. Obviously, the higher vaccination rates help, but if people even if people do get COVID, that they can be less impacted, which is good for economies, because it allows economies to continue being economies and people working and all of that sort of stuff. So that would have otherwise, I think, had a really positive impact on markets. But what it's done, because the markets have been copping a bit of a battering, is instead it's sort of slowed down that decline in markets. So thankfully it's there. Good for everyone's portfolio, including mine. But I think that will hopefully, as it starts flowing through, and maybe we can get even more developments in that space, that should be, again, positive for markets. In terms of the economic data in Australia, we saw cash rates unchanged at 0.1%. Economic growth, though, has gone up significantly from in the last little bit. We're running at an annualized rate of 9.6%, which is a bounce back from the pre-lockdown sort of growth rates there. Inflation is still pretty steady at 3.8%, so it's higher than the RBA's long-term target. That's that people are spending a bit more money, especially on some of those chunky consumer goods that are in high demand at the moment. One of the things from people being locked in their COVID bunkers is there's a lot more disposable cash, so people are spending more money. But while that number is higher than what the RBA would like it to be, it's good to see that it's not increasing further beyond that. The unemployment rate has reduced to 4.6%. I think that's the lowest ever rate for, ever, but definitely for a long time. And the employment growth is at 5.4%, which is slowing slightly from last month at 6.3%. Wage growth, good news for everybody earning a wage out there. That wage growth is at 1.7% over that month, which is great. And that's flowed through to earnings. The household savings ratio, though, interestingly, has declined a little bit from 11.6% the previous month to 9.7%. That's how much of people's income they're actually saving. But 9.7% is worth noting that it is way higher than what it was pre-pandemic levels as well. Dollars slipped a little bit in the last month from 74 cents US cents to 73. And yeah, China's growth rate is steady, which is helpful for our economy. Obviously, we're quite tied together. So in terms of the US data, and US is an important one to look at because it is a big driver of global growth and markets as well. But we saw, similar to Australia, employment growth, but slower, and inflation starting to come down a bit in the US, which is very good news for everybody because their markets are so big and their inflation was actually getting quite high. There's a lot of doomsday naysayers out there talking about this hyperinflation and the world falling off the end of a cliff, but good to see that one slowing down, one to keep an eye on though in coming months. The output or the growth of the economy has just moved above where it was pre-pandemic, which is good to see. So clearly the government intervention is working, rightly or wrongly. My personal view is that, it's impossible for governments to just continue spending, but at some point, I think they've got to pay the piper. But for now, it's propping up the economy, which is good for everyone, good for markets, which is, I think is a good thing for markets and investors, of which I am one. So that, and a really interesting stat to see that recovery has essentially fully happened. Income is increasing in America, and savings rate similar to Australia, way above pre-pandemic level. The bond market interest rate increases was the other big thing that we saw there. Now, our investment story from the last month, bit of an interesting one. Reece in Australia, it's the country's largest plumbing and bathroom supply company. With the COVID boom, clearly a lot of people are making sure they've got the shiny chrome taps or something in their bathroom so that they're comfortable living at home. The share price up like 135% in the last year and a bit, which is great. So that's flowing through to a lot of other similar businesses, JB Hi-Fi, Temple & Webster, that sort of stuff. And but interestingly, for Reece, that their return on capital, so what the return is that they're actually getting on the money that's inside the business, has been reducing over time. So while the share price is way up, the outlook is a little bit uncertain for them. There's a lot of stock people talking about it being overvalued. So, if you're following the trends, maybe just a bit of buyer or investor beware on that one. Our money hack of the month is around property buying, and I touched on this at the top of this little note to say that, with the potential changes to what's happening in markets, borrowing standards rather, that you probably, if you're taking a long-term view and looking to get into the property market and invest, I'd say that you want to make sure quickly that you're lining your stuff up. There's a lot of people talking about stress being priced out of the markets, and it's hard to avoid the anchoring that we get when you see that property for sale for $500,000 or $850,000 or $1.5 million or whatever that number is. And then you go back 6 months later or a year later and it's added 10% or 20% onto that value, that we have this price anchoring that is difficult for us to get past with that stuff. So hard for us to actually realize that the new price is the price. And I'm not saying to go off sort of willy-nilly on this stuff. You want to make sure that you're rock solid with your property strategy. Clearly very big investment. But if you're taking a long-term view for buying a solid property with that long-term time horizon, if you choose right, then it's hard to imagine worlds where your property, like a good solid property, isn't doing what it should do over a long period of time. So don't listen to the media hype. Make sure you do your research, do your solid planning. But I think that there's a lot of opportunity. Now, I think back to when we were saying this stuff in the pandemic, when everyone was an armchair economist and thinking about like JobKeeper is going to end and the property market's going to crash and all this sort of stuff. And a lot of times these things don't come to fruition. So it's critical to have good risk management in place, but being smart and taking opportunities when they're there is what's going to yield you returns over time. Our client problem or challenge of the month is around tech company shares. I touched on that as well, that the NASDAQ in particular, the big tech stocks in America, have copped a solid battering in the last little bit. And we're seeing a lot of people that had been watching prior to that, they're seeing this big run in share prices, and looking at them, thinking that this is this never-ending bull run, and they've taken a pretty solid haircut as a result of some of the recent changes. So, when you're just invested into tech shares, you've got a clear lack of diversification. You've got all this involvement bias because you're tied in, mentally you're there in the company. We've got there's a lot of psychology stuff, and I'm actually going to talk about our book of the month, which covers a bit of that for anyone in this boat. But the volatile ride of the highs and lows of these companies is a pretty wild one, and can be quite stressful as well. So when you're heavily invested into a tech stock, you can hold all, you can sell all, or you can hold some. Any of those things can be good or not, but having a clear plan is going to give you a lot of confidence and peace of mind that you're doing the right things based on what your longer term plan is, not just getting caught up in the water cooler or the Zoom breakout room conversations around that stuff. Our success story of the month is one that I'm really chuffed about, which is we've been talking to a client that came to us a few years back, and they were in a good position at the time, earning solid incomes, young family, but sort of caught in this bit of a spending trap, had these niggling little bits of debt that they just couldn't seem to shake, and put in the work, set a solid plan, could see the potential, got motivated, put in the work to make it happen. Now, it was about an 18-month process and took a bit of back and forthing, working on the spending, saving, cash flow management, making it easy to save, avoiding that spending trap, ditching that debt, and then creating the platform for what came next. And then they ended up actually moving overseas. But because they'd set those foundations before they'd done that, they managed to do their stint overseas, have just returned to Oz with a decent chunk of change behind them, and now getting set to enter the property market, which I've been told definitely would not have happened. And in my view, I agree that if they hadn't put in the work before they got there. So interesting one. Again, I think people can think this seems simple, but it's common that we end up, our psychology works against us and we end up chasing our tail. Those foundations, though, are really critical for success over time. So you want to put in the work to get them right. Now, it definitely comes more naturally to some people than others, but for anyone, regardless of whether it comes natural or not, you need to put in the work to make it happen. And once you do, then you can use that as the platform for whatever comes next. So not easy, but worth the juice is definitely worth the squeeze on that one. And that was one I was personally involved with. So it was a good one to see. My book of the month, and I got a bit of positive feedback on this from last month, but it was Thinking Fast and Slow by Daniel Kahneman. I'd give you a word of warning here. It's a super dense read. I felt like it was a real life goal when I actually finished reading it, because it is pretty heavy, but it's got a ton of this behavioral psychology and finance, personal behavioral finance stuff that impacts how we invest and manage our money. Talks about how your inner investor is flawed, unpacking things like that involvement bias, where we're involved in stuff and we feel like we've got, it's more likely to be positive. We've got this information bias that if we see a stock price, we think that magically tells us about the company, or we read a news article, we think we know more than we do. And then we're always looking, because we don't want to be wrong. We want to confirm the things that we think, and then when we do that, we're thinking more and highlighting the positive things that we've found out about something, avoiding those negatives, and that tends to push us to make worse decisions. Look, it sounds pretty pessimistic, but if you've got it's not all doom and gloom, because if you've got a good decision making framework, you can overcome these biases and follow things through to get the results that you want. Bit of an update from what we're working on at Pivot. We was pumped to wrap up September over the month of September. where we had the team doing a bit of challenge around taking steps for cerebral palsy. I think it's fair to say that I got fully pumped by the team. I had some high hopes on keeping up with the Joneses. I'm a pretty competitive sort of person, but I got dominated by Ems in our team, who totally crushed it. She did like 250,000 steps, or maybe it was even more than that. Destroyed me, and we've managed to step out like 1.3 million steps or so across the team, which is amazing to see. Raised a bunch of money for cerebral palsy and people impacted by that as well, which is quite cool. And also we kicked off our own financial services license, which was really exciting. That started on the 15th of the month. So was really, good. There's been a lot of work behind the scenes in doing that. Basically, you need a financial services license to provide financial advice. And we had co-opted a license for a number of years with some good mates of ours and guys that started the license a long time ago. But as the evolution of compliance and all the exciting world of that has changed around financial advice, made the call to get our own license, which is really exciting. And the other update from our end is we've just kicked off a whole ton of online events. So if you're keen to up your money game, you can check out more about that on the Pivot Wealth website. Guys, I hope you found that helpful. It's been a big one for markets, but I think there's still a lot of opportunities for investors. So more relevant to make sure you're dotting your I's, crossing your T's, know what you should be doing to have a solid plan around your investments. But again, a lot of opportunities out there. So hope you enjoyed that, guys. I'll catch you next time.